All right, good afternoon, everybody. This is Event Trader here. We're about to get started with the Sentiment and Flow Show. We are going to be joined any moment now by Brett Manning. Brett, you there?
Here.
How's it going today, buddy? How you doing?
It's going very well, Gavin. How you doing?
Not too bad, not too bad. I saw you played a quick dip in the YMs earlier. Now, I believe you're out of that trade at this point, right?
Yeah, right. I mean, it was a knee-jerk reaction to a headline I actually wanted it to dip a little bit deeper after I put the initial piece on to double up once and then play for it to move back up to retest the highs, but I didn't quite get that chance.
Yeah. Well, you still made money, right? So, I mean, that's always...
Still made a little bit, and may jump back
there.
in. Yeah.
So, all right, Brett. Well, it's been a couple of weeks since we talked, obviously. We had the holiday period in there, which always kind of throws things for a loop and really kind of dulls what's going on for the most part as well, I suppose. But it's been a few developments, and really what I think we're going to center this talk around more than anything is what the events coming up. It's going to kind of be a two-parter to really close out the year for us here, where we'll be doing a lot of looking ahead at the Fed, the ECB, the UK elections, and of course the December 15 trade tariffs, and how that has kind of played into or how that will play into sentiment. But for the most part, just kind of recapping what we've been talking about the last few weeks, we discussed a lot how the sentiment data just simply wasn't showing through when you compared it with the price action that was going on, and the flow data too, for that matter, where we kept continuing to see money flowing out from equities and into bonds throughout really late summer and into early fall. And again, that sentiment data remaining negative, but the market's holding up pretty well. So we were talking a lot about this FOMO trade going forward. So I think we did a good job at handicapping that. Now, in the last time we talked, though, we did note a couple of red flags around these highs. We're trading right around that 3150 area in the S&P at that point. And we noted some of the risk that was coming on in terms of a little bit of complacency, a little bit of risk on, and, of course, the idea that we were priced to perfection on this trade deal, and there was a good chance of some headlines that could rattle us. So with that recap, Brett, do you think there's anything I'm leaving out here? Is there anything that you think was important that's gone on over the last couple of weeks that I've failed to mention just then?
Well, no, I bet to drill a little bit deeper. I think the last time we talked a couple of weeks ago, we started to move toward the point where, so we had the inverse ETF data, we had the SPY liquidity data, we had the VIX term structure, all really short-term indicators, and the put-call ratio on the 10-day average, everything had registered the type of things that you want to see to start to look for a shakeout. And I like to think in terms of let's maximize the shakeout risk, then find a catalyst, get the shakeout, and then if that catalyst is something that can't really bear out to be a larger trend change, that's a long side opportunity after the easy money, after the weak-handed money is already shaken out of the market. And we came in saying, maybe this weekend, and I think we actually said this, maybe this weekend we will get summary data on the robo ratio that will lead us into next week with an extreme in the robo ratio finally. And that's sort of my favorite one to look for that shakeout to be extra well set up. And that's the retail only buy to open put call ratio, which basically measures smaller trader accounts when they start to form a consensus around leveraging up on calls. So basically playing the long side on small accounts with leveraged instruments in a herding fashion. And that's oftentimes when you have a market that's simply gotten too far extended to the upside. People have gotten too used to trying to bet on that next tick higher. And sure enough, the following Monday morning, we came in with an extreme in place in the robo ratio, which is a back-tested sense of like, well, when it gets to this point or through this threshold, then historically that's been a problem for the market. And at the same time, we were just starting December. We were just starting the 2-week lead into the December 15th tariffs. And of course you're going to get some kind of bluff. I mean, we've got we've got that kind of political scene as much as we've ever had, that you're going to game headlines and that you're going to try to find negotiating leverage by, hardball tactics, especially since we were coming off of, I think, the best ever Black Friday and Cyber Monday sales, and at the same time, much better than expected Chinese manufacturing data. So you got both Washington, D.C. and Beijing feeling like they can go ahead and play a little bit of hardball because they're neither one of them in a desperate situation. So it all added up to a shakeout, and it really played out very nicely in that, about midway through Tuesday after the shakeout, that was the point to start buying back in. So we were able to put on that S&P long for nearly 60 points over the next day and a half or so. But it was an almost too perfect kind of process in terms of using sentiment data to key in when that opportunity is likely to be present based on a geopolitical context. And that right now, I think more than anything, if you're a macro trader, that's the game that we have right now. We have sentiment data being a background measure that's really important to understand, and then to understand the kind of rhythm to the geopolitical headlines. And they both kind of came together last week. And now we're in a situation where that trade is through, and we've got a bunch of other macro catalysts lined up right now, but we don't have the same extremes in place because we're on the other side of that kind of shakeout that cleaned things out a bit.
Right. So let's take a look at some of that sentiment data and where we stand with it now, updated from the last week. So basically, there was a couple of instruments here that I was looking at that were falling in on the overly pessimistic side here, Brett. The two of them were the strong dollar and the small put buying ratio, which the small put buying, I guess that's even smaller than the robo. Is that how you would define the difference between?
Well, and it doesn't include buy to open only. So it's the put call ratio using only data from smaller orders. But
would you look at that as more of a hedging strategy?
I think it's just an inferior measure to the robo ratio. I track it to see if the two are really out of line. But the robo ratio I think is more interesting because it shows you, again, that's from clearinghouse data rather than option exchange data. So it shows you the fact that you're dealing with positions being established in the market rather than, if you buy puts simply because you were short puts, that's not the same thing as if you buy puts from an empty position.
Right. Now, and they were the only two that were really striking me as falling into the category that you got a little bit of a red flag next to it. Now, some of the ones that were closer, these are all measures that we've spoke a lot about. Now, they're still in neutral territory, but you could say that they're edging into that direction. That would be the SPY liquidity, the robo ratios, as you just discussed, and the inverse ETFs. But none of them are in that level. Is there anyone in that group? I know you just mentioned robo.
Those really aren't verging on extreme pessimism. I mean, they're just in the mix. In fact, I think with Lobo and Robo, they're closer to extreme optimism. I think that really the small trader put buying is an anomaly, and the strong dollar assets data point is really shifting.
It's been in there for years.
Yeah, I think it's shifting in meaning a bit. It's like when we used to follow Ridex, and I might start to pull it out of my watch list at this point.
Yeah.
But I think everything else is either at a little bit of a red flaggy position or close to it. I don't think there's anything that's really close to being in deep pessimism at this point.
Well, yeah, they were in neutral. Oh, definitely not deep pessimism. I agree. They're all in neutral territory. But when I was looking at the ratios, they were leaning, I guess you could say, over the 50 line, if you want to say, but none of them were getting out. I just figured that I'd flag them just to see which one is jumping off the page to you.
Now, one thing I'll say is when you're an upward trending market this is not an even playing field. A downward trending market is much more vulnerable to a bounce when you have overwrought pessimism than an upward trending market is vulnerable to a pullback when you have too much optimism. It is not even, and that's because the equities market is not symmetric. 90% of people are long only, 10% of people are both ways. So it's not like a currency market where things are 50-50, or even some commodity markets where things are 50-50. It is really sloped in that direction. So you can have everybody pretty much bullish and a trend that can continue on for miles up the road. So, but when you have everybody bearish, be very, very hesitant to short. So
Right.
it's not really a symmetric set of relationships there. So this isn't something that worries me. I'm not going to fade this market because everything is, the optimistic side of neutral or barely verging on historically extreme bullish levels. Like we don't have, for instance, the surveys aren't there. They're just sitting there. If you look at like AAII, or the hedging data is not, the hedges aren't off. There's still people hedging in this market for sure. So we're not anything even close to like where we were in, let's say, mid to late January of 2018, which is something that stands out. If you look over 20 years of market behavior, that's a period that stands out to where people were genuinely buying into the idea that this was 1996 heading for 4 years of some gigantic breakout bull market. Like that was the sentiment around that month, and it was
What
the
month are you
month
saying now?
January
Yeah, yeah.
2018, a month after we did the tax reform bill, and the sky was the limit. That was the sentiment, and that's when it really got dangerous. And that's when we started looking for a crash, right? And looking for the bubble in the short ETFs of the VIX. So the short VIX, the SVXY, and stuff like that. When we started looking for that crash, that was because of that sentiment environment. So we're nothing like that right now.
Nothing
Just
like
not
that,
that kind of
but
environment.
there are a number of indicators that are starting to rise
Yes.
up, and we talked a
Right.
bit about it. So let's go through some of these. Obviously, risk appetite is one. I think that's fairly evident in the market action we've seen. The high-low ratio, which is what we discussed, which is basically the difference between 52-week highs and 52-week lows, are at some of the most extreme levels there. And for anybody that missed the last Sentiment and Flow show, Brett and I talked a lot about how basically what this means is that people continue to buy the best names and sell the worst names, and that could tend to lead to a little bit more risk when people start leaving the big names because they'll be a little bit
Hindenburg sort of idea.
exactly, they'll be quicker to leave the big names rather than just buy into the weak names at a quicker pace. I guess you could call it your movie analogy, right, Brett? Where people slowly come in and then all leave at once would be a fair assessment for that high-low
And
trade.
it's fair to take a moment to just, for people who haven't heard this before, I really think this is a fundamental principle of markets. People come into a movie theater in groups of ones and twos over the course of 20 minutes, and they leave in a giant crowd all at once. Just extend that to markets, generally speaking, because that is what you see across the board. People come
Yeah,
in as
it's one of my
independent
favorite
decision makers, and they leave
analogies
as a
for you.
crowd. Yeah.
So
So
I
and the
like that
movie is
one.
playing right now, and eventually it's going to end. The credits are going to roll, and every single person's going to get up and try to leave at the same time.
Right. And cash funding, we discussed that this was being drawn down as people are putting a little bit more money to work here, it seems. The AIM indicator, which is, of course, all the asset manager newsletters that are out there, they've been certainly striking a more bullish tone as of late. I do have something to add to that, though, that we'll discuss shortly here. But this one I thought was interesting, the option speculation index. So it's at
Right.
1.3 right now, which obviously kind of falls a little bit off from the Robo and Lobo. So I'm going to ask you for the difference between the two. But the last thing I want to note on this option speculation index, the last couple of times we saw it at 1.3
Trouble ahead.
was in July. May, which is of course the last time we saw a big trade deal fall through, and then of course last October, which preceded a slew of selling towards the end of 2018
Hmm.
that culminated with that Christmas Eve massacre, if you will. But why don't you talk a little bit about this option speculation index, Brett, and what you're reading from that?
So the reason why I think that it stands out a bit is my sense is there has been a tremendous need to have optionality, and no, I don't just mean options orders, but optionality for institutional money managers who know they need to be exposed to this market, but it's very difficult to feel at ease with naked, uh, large, long side exposure for any period of time, and that's because of the constant uh, uh, interjection of headlines that appear to be game changing at any given moment, and the willingness of people behind those headlines to use the media to try to move forward negotiations. And I think that it makes everybody a little bit gun shy. And I think that options orders and large options orders, big shifting tranches of hedges, have been in a sort of trigger happy mode for a while, and they're swinging in and they're swinging off around core positions because they know they need to be exposed. And especially after we've started to break out to new all-time highs, that's an important technical indicator. If your benchmark that you're measured against is moving forward, it's at all-time highs and it's progressing higher, and you're not exposed enough, it's awfully difficult, particularly this time of year, to be willing to sit there and cash. So the swing factor is, well, you get your exposure, you get your portfolio, but then you're using the options market to kind of modulate exactly how exposed you are. And I think that those hedges, in this case, I think that we're starting to see a lot of the put orders be taken off, a lot of the put positions be taken off to try and stay with what this market is doing. And I think that's where this speculation number is coming from. I'm not sure that it's so much a lot of calls being bought to speculate on the upside of the market. I think it may be portfolio managers removing option-based hedges as the market moves higher. Okay. Which it can be just as dangerous, right? I mean, you're becoming more nakedly exposed, and it's similar to what we saw in the Robo ratio in a way, in that it re-exposes a nerve to the world, and so the next time the hammer strikes, you no longer have your armor on, and you just got a naked nerve sitting there, and it's much more painful. So, we may see more intense knee-jerk selling if we see the narrative, the larger narrative, take a turn for the worse.
All right, and then we have the hedge fund exposure, which, again, high since July, which is, of course, right before that August sell-off. So,
which I think is interesting. If you look at the chart, and this is something I talked about in the last chart book, I think that we've seen this repeated pattern where every time the market tests or breaks out to a new all-time high, the hedge funds go from being way underexposed to being overexposed.
Right.
You can line it up, and I did a chart in the last chart book where I just showed, okay, this is the day that the S&P went to an all-time high, and you can see over the next 2 weeks, the hedge fund exposure goes through the roof. So they're basically chasing that breakout.
And we could build off this a little bit, Brett, with another one of the bullet points that I had for our outline, because I think it's pertinent here. The trend-following commodity hedge funds are now at about 50% exposed to the S&P 500, which is the highest in 2 years. The last time this exposure jumped this quickly was in July and October of 2018. Again, another October 2018 here, and this kind of builds off that hedge fund exposure where it seems like a lot of commodity players have been jumping in here. You got any read on that?
Yeah, I mean, it's like a CTA sell signal, effectively. I mean, because it's a CTA buy signal, it's a momentum, like we've reached a threshold where you have those more automated trend-following systems in the equities market get to the point where, we've had a steady upward move with the market at new all-time highs, and eventually you get to thresholds where and the time period that you're talking about is a time period where if you just pan back and you look at a weekly chart of the S&P, it has been a range trade period over that time frame, right? I'm sure that if you go back to, let's say, from 2012 to the end of 2014, these types of moments, these 50% thresholds probably have a different outcome. Or if you go from maybe mid-2016 to late 2017, there are times when the CTAs get to that point and the market can still trend a ways, but we have been for this period, for the last couple of years, we've been in a period that is characterized by you hit an upside threshold and the market has some kind of dagger to the downside. And it is by and large, I mean, particularly if you look at something like the Dow over that period, it's really like the market is sort of just eking out to the upside out of a 2-year violent trading range.
All right. And within that, I really wanted to talk to you about copper as well, Brett, because it's making a nice little breakout here at the moment. I don't have a copper futures chart, so we'll just take a look at the COPEX here, which is the miners. Let me see if this one will work.
JJC is back, by the way.
Oh, it is back. Okay, nice.
Yeah, they brought it back from the dead.
It's back, baby. It's back. So it's different from the
It's really thin, but it will show you the chart.
CPER. Okay, so we got the JJC back in business. Okay, and there you go. You can kind of see that breakout that's forming right here. You got to go back to May since the last time it was this high. But really some important levels here. Based, you would think around some of the global data that we're getting. I thought,
I
um,
guess.
I,
Yeah.
I mean, no, not the hard data
One thing I'll say is
on
if
the
you
emerging
compare
growth side, but I
if you
did,
compare
I
it to
was,
bond yields, that analysis doesn't hold up. But yeah,
yeah, but I would say this, Brett. I don't know if you saw the zoo economic surveys from Germany and the Eurozone today. I thought that they were pretty interesting, and obviously the PMI data from China that we've been getting the last couple of rounds has been a little bit better than expected, moving back above the 50. So I think that's where you're getting that copper move. And another item that we'll talk about on that data front too that I think could be helping here is some of the inflation numbers that we're seeing in China and Italy and Australia as of late. I don't know if you've been paying attention to that.
no, but I mean, not as well as you have. I'll say that most likely. But I have a sense that the path, the glide path for global PMIs, generally speaking, is usually pretty well reflected in the positioning ratio for CFTC data. If you take a ratio of gold to copper positioning, generally speaking, and that would exactly reflect what you're talking about. That we are seeing a moderate shift toward, let's say, less of a bet against inflationary growth.
Right. Yes. So it should make for an interesting metal to watch, obviously, going into 2020.
Yeah, we still
Now,
have huge short position there. Let me just say that too.
yeah.
So if it does turn out that this evolves into something that's more intense, is potentially enormous upside for copper.
Yeah, and again, a fantastic way for people to play this is Freeport McMoran, of course, FCX, which you can see it's really making a nice looking chart here. This is the daily. Now I just pulled up, breaking above that 12 level. We're talking a lot about it, right around 10 post earnings, and this copper breakout bodes well for FCX, so that's one that you got to have on the radar. Let me ask you about this, Brett, as we'll throw this in under the sentiment section. 2020 analyst predictions so far. On the average, this is according to a group taken from the Bloomberg survey, looking for a rise of 4% in the S&P in 2020. This is one of the smallest predictions over the past 20 years. The average over that time has been approximately an 8% increase. Now, I would say this: it's been a pretty poor predictor. It's funny. It's funny because I mean, you think of all these people that are making these predictions, and they're really smart people. It's just
Uh-huh.
I don't know what it is with herd mentality or something. But like I said, it just hasn't really been an accurate predictor. But do you got any thoughts on this outlook for 2020? Does it flip you one way or the other?
Variations in a set of meaningless data are meaningless.
Yeah.
Yeah, I think that people who attempt to make predictions about exactly where the S&P is going to be at the end of next year are, like if you ask random people on the street, you might do just about the same thing because they're going to go toward, well, a little bit up because that's most every year in history on some level. And so I don't think this is based on a tremendous amount of, of quantifiable calculation beyond just sort of, I think the ratio of calculation to gut feeling here is pretty poor, and gut feeling based on, what's the weather going to be like 4 months from now in a city 20 miles from you? What are you going to say? You're going to say maybe partly cloudy because that's about what I think weather's generally like if there's nothing crazy going on. So I think that's where we're at with that. I really have no faith in next year, end of next year analyst predictions for where the S&P is going to be. I think it's a meaningless data point.
Yeah, I'm gonna have to dust off my 2016 webinar that I did on election years too. I'd be curious to see where we stand with that. So let's move into then, Brett, some of this flow data here, and take a look at some of the things. Oh, I'm sorry. There was one other thing that I wanted to ask you about. I forgot to throw this in, into our notes, Brett. So I apologize. So not trying to catch you off guard, but I know you're pretty quick on your feet. The
Uh-oh.
SKEW index, SKEW index. Looks at the risk of black swan events in equities, and over the next 30 days jumped to the highest level since October 2018. Um, Generally, some mixed results from this index in the past, but obviously, if you're looking at it, the black swan, I think, event would be this trade deal not happening. So, just curious if you got any thoughts on this index itself and any read, or do you think it's just a fun thing to talk about?
No, I mean, I think it's a fun thing to talk about. I think the SKEW index has been particularly volatile, and of course it would be, and it has been qualitatively changed, I think, in the environment of what has happened since the last election and the different mode of catalysts in the world of markets. I think that the ability to predict what major risk factors are going to come over a larger time frame has become, you know, a very different kind of process than maybe it has historically been during this period. But yeah, there's a lot of big binary factors out there. And when you have big binary factors out there, something like the SKEW index, which is a measure of potential risk based on, you know, sort of tail risk positioning in the options market, you're going to get a lot of wild bets around the two big fat tails in that process. And we've got a lot of big binary factors that are always in play right now. But certainly, yes, how the election comes out and how polling comes out and who the candidate is, if it's Elizabeth Warren, that's probably a big skew factor as well because of the different mode of all sorts of factors that could impact asset pricing that could come into play then. Certainly, yeah, how the U.S.-China trade negotiations go, and if we see things break down further there, if we see a tipping point in how this administration is going to structure its plans for how it's going to campaign around that. There's all sorts of factors, I think, that are huge there, and you got to take into account Brexit as well. I mean, there's lots of big binaries, so the SKEW index is going to be having a really difficult time pricing that tail risk.
Yeah, no, they're all good points, and we'll break into a few of those shortly here. But taking a look at the flow data, Brett, I think it's, we have a general feel what's going on, but I guess maybe a recap of 2019 probably bodes well for us here. But investors have pulled out approximately $200 billion in 2019 in equity funds, that's mutual funds and ETFs. This is according to Investment Company Institute. However, what's amazing about this, Brett, is because of the large gains, the outflow is only 1.5% of assets.
Which leads you to the theory that a lot of it is about rebalancing.
Exactly.
And it's about fixed weight. It's about the risk parity guys. It's about pension funds. It's about insurance companies. It's about big market players that aren't really betting on cycle swings.
Yeah, and I think that's pretty much our biggest take from that. Now, do you have any thoughts on the bond market here? Are you concerned with yields starting to pick up a little bit faster than expected, perhaps, or and some of these bonds just kind of selling off here into the end of the year, or do you feel pretty comfortable?
I would think it'd be worse than it is. I'm surprised that yields have not risen more than they have over the last week or two.
Yeah, no, I would agree with that. One of the things that I found of interesting too, it kind of plays into that high-low call, is the fact that the difference between investment grade and junk bonds has been really picking up here as of late. As we're just seeing people continue to flow into the better quality investments. So again, that bonds, similar to equities, are also falling into that high-low type trap. So something to watch moving forward for sure.
Sure, but we're not really seeing credit spreads widen particularly.
Credit spreads are not widening.
I mean, we're not seeing the danger factor come in.
There's no danger factor, exactly. But I'm just saying, in terms of if we do see that widening, that selling could be pretty abrupt and aggressive, I think.
Oh, Movie theater.
Movie theater.
Big time.
Exactly. Exactly. So let's start breaking in, Brett, into some of the big events that we got coming up here. Unless, is there anything on the sentiment side
No, no.
or flow
Go for
side
it.
that we missed? So let's start off with the Fed. Obviously, they kicked off their 2-day meeting today. Tomorrow at 2 p.m., they'll post their updated statement, their projections, and their dot plot, of course. And then at 2:30, Fed Chair Jerome Powell will be taken to the microphone. Now, overall, this is expected to be a relative non-event. The Fed, I think, is pretty content with where they have the markets. If we're looking at the CME, Fed Funds Futures, there's no rate hike expected until November 5th, which I think is the day after the election, right? And even that's only at
Right.
51%. So I found that kind of ironic that the Fed's positioned for a meeting right after the election there. So that should be
After.
interesting. Yeah,
Yeah,
right after. So that'll be an interesting one. Um,
it will.
but some of the things that I was looking up, Brett, going into this, I think the Fed doesn't want to move its message at all, so they're going to be quiet as a mouse here. I wouldn't be surprised if we saw Powell walk up to the mic and say that's it and walked back. But a few things that we got to watch here. Did you realize that the Fed's expanding its balance sheet faster right now than it did for QE3?
Yes, I did.
Yeah, so I mean, I find that to be fascinating. And I get it's the
But
day
it's
to
not
day.
QE, Gav. It's not QE.
It's not QE though. It's not QE exactly. I think that they're going to be kind of hammered on this point. I don't think that they'll get off their target that this isn't QE. But I just found that amazing that this day-to-day operations for managing repo is more difficult than keeping the economy afloat. And I think more than anything, it'll point to potential regulation changes,
Yeah.
depending on who gets into the White House next year. But one of
Yes.
the other items of interest, of course, is going to be watching the GDP and inflation targets for 2020. We've heard the Fed talk a lot about letting inflation roll over its 2% target. And I believe that this is going to be a pretty hot topic on Powell's conference call, too. So,
Pause. Let me pause and put a star on that. So, yes, Gavin just said the most important thing for this Fed meeting and for the Fed for the next several meetings is the notion that their symmetric 2% target is probably in the process of evolving to a higher number.
yeah. And again, this is all part of that price targeting that was put forth by John
Correct.
Williams a couple of years back. And it really just seems to continue to garner steam moving forward. So,
Let me put a
again,
star on that one as well. Hold on, Gav. This basically says if you have inflation running well under your target for a period of time, then you can't just get it back up to your target because the total price where you should have prices, it won't be as high of a price, right? Because if
the
inflation is
new normal
increasing,
rate, if you will, the R rate, the R
well,
star.
if inflation, if the price of something goes from $100 to $102, it's gone up 2%. But if for a period of time it goes up by less than 2% a year, then if you imagine over the years, if it were always going at 2%, it should be at a much higher price than if it were going up at 1% for a number of years and then just goes up to a 2% change the next year. You have to run it at 3% for a bit to get it caught back up to the price level it should be at. So it's like making up for a period of slow inflation. So it gives the Fed an academic justification to raise the inflation target so that they can tell people through that channel of communications that they don't need to be worried about the Fed stepping in, so that people will continue to invest in things that would be hurt by the Fed stepping in and getting in front of it if inflation got to 2.1%.
Right. So, I mean, and I think that there you have it. Those are the three most important points that we'll be looking for tomorrow. And again, that is the GDP and inflation targets, and then the comments around this 2% targeting that I'm sure Powell will be asked in the call. With that in mind, Brett, a quick chat on inflation, because we've been talking about how little positioned people are for this. To go back to what I was talking about earlier, China's CPI today comes in at plus 4.5% year over year. Now, on the flip side, of course, their PPI comes in at minus 1.5%. How much of that CPI number do you think is because of them allowing the yuan to devalue, and how much of that PPI is, do you think, because perhaps they've been front loading a lot of their imports in order to get everything in ahead of potential tariffs, and thus the lower PPI?
Yeah, I don't know.
Okay, no,
I don't even have a speculation on that.
okay, that's fair.
I
That's
think
fair
that you've
enough.
got I think that that's a good framework for thinking about it, but I can't
Right, and I don't.
set a
I think that
percentage chance.
it's a framework, but to be clear, I don't think that there's any real proof on either one for what it's worth. But then we'll move over to India, who didn't rate their RBI was expected to cut rates and they didn't because they uh, because of food inflation. And then we'll pop over to Australia this morning that had housing prices running higher than expected too, which is one of the reasons why the RBA also didn't move on rates the last month. So my question to you, Brett, is we've heard a lot about this inflation, the lack of inflation in the U.S. being because it's been exported from China and other emerging markets. How much would you be looking at these rises in some of the emerging
Deflation has
markets?
been exported from emerging
Deflation
markets.
has been
Yes,
correct. Yeah, so
correct. Which is what's
deflation has.
happening. Yes.
But now as we start getting the reflation in the emerging markets, does this raise a red flag for you potentially? We've talked a lot about this offsides portfolio and the fact that nobody's positioned for it. So these news items, that raising a red flag for you at all?
So, I mean, deflation is exported through the mechanism of the currency, and we haven't seen a suddenly really strong yuan, right? So
Right.
that would be what would have to start happening is for the currency to start to strengthen. That would be how they would, if they're weakening their currency, they are exporting deflation. It's something that it's mechanistic. But I think generally speaking, though, yeah, I think people generally speaking are still not positioned for the possibility that we could see a sort of meat and potatoes increase in inflationary growth. And that says nothing about the likelihood of that. It's just pointing out the vulnerability in positioning.
Correct. Yeah,
I mean,
to be clear, this isn't a baseline, but this is just the understanding that, the last fund managers survey, Brett, I think it was what, 4% of people were
4% of
expecting?
people expecting increase in inflation. So yeah, I mean, I think one of our jobs here is we look at it as like, oh, let's point out the things where there's an anomalous, black swan-y kind of lack of appreciation for something. It's not necessarily whether or not that thing is going to happen. It is pointing out where the gaps, the holes in portfolios are, so that you know that that's going to be where in an if-then flow chart of future reality, that's where the largest asset moves are going to happen if they are in some way speaking to those gaps. And it continues to be the case, I think, at this point, pretty clearly, even with the movement in the S&P. And this is why I brought up bonds earlier. You're just not seeing, even with the jobs data we just saw, even with the great Black Friday sales and everything, you're just not seeing U.S. interest rates at the long end of the curve particularly move. I was looking for just an absolute dive in TLT off of that jobs data. It just didn't happen. I mean, we had the pre-market knee-jerk move. Equities market continued higher during the day. Bond market did not continue lower during the day. We did not see, the 10-year yield take off to the upside in the aftermath of what looked like a very surprisingly good jobs number. So we didn't see any of that. And just to be clear, the long end of the curve is not controlled by the Fed. So it's not a statement about what the Fed is going to do. The short end of the curve is controlled by the Fed. The long end of the curve is controlled by the market and inflationary expectations. Now, maybe this has something to do with expectations of how the Fed is managing its balance sheet now. I don't know. But I tend to think that it has to do with the fact that people just really don't believe that a year from now we're going to have an inflation problem. I think that there's this sense that no matter what we're doing across the board, we're just pushing at one end of a string. And there's some kind of, whether it's demographic or whether it's technological or something is just preventing there being inflation in this world at this point. And so people are taking it as, well, this is a really easy way to position because I don't know why, but it doesn't seem to matter what we do, there's never any inflation. never any inflationary problem. But the fact is, you're starting to see it creep into data a little bit. So there's a perception that I just described, and then there's reality, which isn't quite so firm. And so there is the possibility of that perception starting to flip. And if that perception starts to flip, you get the possibility of a meltdown in the bond market and a giant squeeze in copper and who knows what. Because that's just not where positioning is. That's a gap. That's a hole in the way that people have positioned money in this world today.
All right. Next on, and Brett and I will be back on tomorrow to do a quick preview, and we'll be talking a little bit about Powell's comments and everything afterwards as well. But again, not expecting this to be a major event. But what's probably the bigger central bank event is going to be the ECB meeting on Thursday morning, Brett. It's going to be Christine Lagarde's first. It's going to be happening at a time where Brightons are going to be at the polls, and we'll talk about that UK vote here in a second too. We're going to be watching Christine Lagarde for her communication and delivery during the presser to see how she is any different from Draghi as we've seen in the past. There can certainly be a little bit of growing pains when a new Fed chair comes in. An ECB chair is not very different. Draghi, when he first started, he's done a great job, but he also had a few hiccups at the beginning too when he took over from Jean-Claude Trichet. Some of the other things that we'll be looking for here is revisions to the inflation and growth outlook, similar to the Fed. The ECB is going to be giving their updated GDP growth for 2019 through 2021 and inflation numbers over that time, as well as their initial look at 2022. I'm also expecting the ECB financial stability. If anybody recalls, I noted this a few weeks back. In their most recent quarterly remarks, they discussed how the current policy was causing disruption to the financial stability, causing people to take increased risks because of that negative interest rate. So I'd expect this to be addressed within during the press conference. Another item that's going to be pretty popular, of course, is the well-known rifts between the Hawks and the Doves, primarily the northern and southern states in the ECB there. And then there's the idea of the strategic review, which Christine Lagarde has mentioned that the ECB is undertaking. This is their first strategic review since 2003, so 17 years without really tweaking the mechanisms around it. So in general, there's not a lot expected from it. In the 2003 one, all they really did was tweak their language a little bit. But some of the things on the table is for the central bank to define price stability. One of the things that could be interesting from an investment standpoint is the inclusion of climate in it. Now, there's going to be a lot of questions around the legality of the ECB having a mandate to address this, but it's certainly something that Christine Lagarde has already thrown on the table. And basically what this is with the ECB bond buying program, they'd be focusing more on corporate bonds that are based around climate change. So an interesting aspect there. Communication tools, of course. Right now, the ECB has slowly been expanding its directive, so we'll see if they got any further to do there. And then there's the interpretation of the mandate, which I just discussed in that climate control thing. But Brett, of all this, is there anything that you're really curious about to hear from Christine Lagarde?
Yeah. So the main thing that's not said there, and not said by anybody, but it's probably still the main point, is the degree to which she can spark some participation on the fiscal side for Europe during whenever the next downturn is, because the next downturn will happen, and they are at a point where I think that there's like a widening gyration process for Europe, where each time they get closer and closer to the entire European monetary union cracking apart during the down cycles. Even back in 2003, it was a small shutter, and then in 2007, 2008, it was a little bit bigger shutter, and then they had an extra leg to the downturn in 2012, where really the whole system almost came apart. And what this really is about is that when you have when the tide goes out in the European Union, and it's unlike any other central bank governed uh, 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 monetary system on the planet, when it happens everywhere, for the ramifications for Europe are that the interest rates between the more vulnerable countries and the less vulnerable countries widen substantially. And we have things like, credit default swaps that go through the roof, which are essentially bets that if so-and-so country, whoever it is, Greece last time around, were to suddenly no longer be a part of this union, would they default on their debt? Because their debt is no longer a credible and reasonable concept without the support of the larger European monetary union. So there's this vulnerability, and it went so far that Draghi last time around had to come out and say, the euro is forever or whatever. There's nothing that could possibly take that next step, because if they don't support it that way verbally and basically throw that hammer down, that at the end of the day, it's all for one and one for all. There is no difference between Greece and Germany, and if you try to short Greece's debt too hard, you're going to find that out, and you're going to lose everything you got. Like, that's the idea. But markets still know that that's not really true, and it's possible that this widening gyration can widen far enough that the whole thing cracks apart. So they need to put in place another mechanism to cause that risk to go away. And that means there needs to be a greater fiscal union of some kind in some way, some form of a linkage, so that it's not just about the central bank expanding its balance sheet infinitely to try to make up for the lack of that force, so that they are tied together. It's more all for one and one for all. And everybody knows that this is true, but there's a big division, and it's part of the division between the Doves and Hawks, actually. There's a big division about whether or not it's kosher to talk about that in direct terms. And Christine Lagarde I see as a force for possibly trying to resolve that to some extent. And I'm wondering if initial steps in that direction will be taken publicly. I imagine not. I imagine they'll be taken privately until she starts to secure
That's why she
some
was
kind of consensus.
That's why she was kind of brought in, right? She did so
I
well with that in
believe
the
that's
IMF
exactly
that,
right. She is to heal this. She is to get backroom meetings with everybody on the political side around the continent to try to get them all on the same page and get some kind of consensus to express this risk. She would know better than anybody from from her last gig that there's what sort of risks loom and what sort of tools would need to be put in place to take those risks off the table. And if she can manage to communicate that in a compelling way to the people who need to hear it and understand it, then it's possible that she can raise that consensus. And then after doing so, suddenly it's introduced to the public, and it would be a game changer for every asset on the planet if that were shifted.
All right, and then we'll discuss real quick, Brett, the UK elections. This is basically viewed as a referendum on the Brexit. Right now, the Tories, Boris Johnson's party, the Conservative Party, of course, is on track for winning about 68 seats, or approximately 359 seats, according to polls. British bookies have it running about 345 to 351. In order to get a working majority, they need 326. So the general thought is that Boris Johnson will be able to get this working majority and push through the Brexit finally after, 3.5 years now, I guess, we're going on. So the general thought is that with the Conservative majority, we should see a rally in sterling, with, I guess, the idea being that a little bit more predictability there, and UK will leave the EU by the end of January, with a transition period through until the end of the year, December 2020. In hung parliament, which is obviously where we've stood for the last couple of votes, the idea is that the pound's going to give up some of its recent gains, and the UK will go back to the table looking for yet another Article 50 extension. If there's an upset in the labor ones, the general thought is that pound could sell off just in kind of a knee-jerk reaction, but many expect that such a sell-off would likely reverse, and then we'd be looking at either a softer Brexit or perhaps even another referendum on Brexit as a total. Now, to To give you an idea, the polls are going to be open from 2 a.m. to 7 p.m. Eastern Time, and the results are expected around 11 p.m. Eastern Time, depending on how well the counts are going for either side. So, Brett, how are you planning on trading around these UK election headlines? Obviously, we're going to have the Fed that people will be digesting, the ECB as a backdrop. So, not so much in terms of your thoughts on the Brexit, but in terms of what you'd be looking for on how it might impact your futures trading.
So, I mean, I think that we've already basically. I mean, I feel like this is a relatively well-resolved situation at this
Yeah.
point. Yeah, and so I don't know if it really is. I'm not viewing it that much as a catalyst at this point.
But so I guess on that front, then, if you see a sell-off in reaction to something, are you buying it?
So I mean, if the unexpected happens, if the polling numbers are completely off, right, and if Labor takes a much bigger share of things, then probably not. No. So I think that in reaction to the unexpected, I don't think that I would see it. I mean, I suppose maybe buying equities. If it were to be seen as a spike of uncertainty, I think that uncertainty would still be on track to resolve. So probably maybe buying equities.
Right. Yeah, that's basically how I look at it too. But I mean, it is going to be a backdrop there on Thursday with the ECB as well too. So it's certainly worth keeping an eye out on, and yet another one of those black swan events that we were talking about earlier. And then finally, Brett, I mean, last but not least, but I just feel like we've kind of beat this horse to death here, and that's, of course, the trade talks and the December 15 tariff deadline. Been seeing, I think both of us are kind of on the same boat here, where we're expecting to see a little bit of brinksmanship going into that. I'm of the mindset that the administration's got little interest to move forward with those tariffs at this time. I could see them kicking it down the road a little bit and moving the goalpost to January 15th to keep it on the table, but to take it off the holiday calendar, basically. The idea being that some of the jobs numbers that we've seen and some of the other economic data in a comparison between the U.S. to China could embolden the White House to be a little bit more aggressive here. But what's your general thoughts as we go into the final days ahead of that December 15th tariff deadline?
I believe 100% that it will be delayed, and I would believe it will be delayed until after the holidays, and then potential hardball will resume at that point.
All right. So, I mean, I'd love to expand on it more, but I feel like we've just kind of talked this one to death. What do you think, Brett?
I think probably. I mean, I think that we had that little knee-jerk shakeout bluff uncertainty that was a nice little buying opportunity, and now we've got a sort of
And we'll probably get a few more of those too, I would think, right?
I would think we'll get some wiggles on it. Yeah, I would think it will still be used as an opportunity to gain leverage, probably by both sides to some extent. But I think that not with the idea that this won't be delayed. I can't see any way in which we're going to see those tariffs put in place on December 15th. Neither side wants that.
All right, so there you have it. So as I was saying, this is kind of a two-part sentiment and flow show to close out the year, in which we've got a number of uncertainties lying ahead over the next few days. So it's tough to get a little bit overly aggressive with the thoughts on the markets here, I think. But overall, I believe, Brett, we both still remain positive on the markets given the setup. The sentiment data is certainly something to keep an eye out on, but hasn't really gotten out of control here yet. The fund positioning remains in favor of the bulls, I feel. But is there anything you want to add? You always do a great job at summarizing the discussion here in a nice, concise manner. Is there anything you wanted to add to that and send us home with?
I mean, I think that we've got a framework that's been correct and will continue to be correct, generally speaking, but we've got a lot of binary catalysts still in play, and I wouldn't get overly presumptuous in terms of large time frame strategies where you lever up, particularly for short-term moves. I think you take advantage of opportunities. I think it's the idea of being opportunistic, with the idea of that there's a larger process unfolding, there's a larger trend in place, and I think that probably still has a little bit of legs. And so just like we did last week, when you see people get too much weak-handed money get stuck into the market, and then you see the kind of geopolitical bluff-based catalyst that shakes things out, it's most likely an opportunity. And it's most likely a relatively easy opportunity to play back in the direction of trend. Eventually, the whole flower will have bloomed, and the movie will be over, the credits will be rolling. And one of the other questions that we haven't addressed, and I think is interesting to talk about, and somebody sent me an email to this effect, which is basically if some of this rally has something to do with the idea that people were malpositioned, and particularly in front of the final 4 to 6 weeks of the year, where you have a benchmark to catch up to, you've got performance review meetings coming to the end of the year, you've got a career that you want to protect, and it's an extra incentive to put money into the market if you're a professional money manager, then what do we get the first week of January? Do we have people who have positions they don't like and they don't want, but they felt forced to take? Do we get the other side of that coin? Do we get an immediate sell-off after year end? I'm actually inclined to think that, yeah, maybe we do. I'm inclined to think that maybe you've got a couple weeks to start off January that could be a little bit rough for the market. So
similar to 2017?
Similar to 2017, similar to 2016, similar to 2015, I think.
Yeah.
But yeah, I mean, I think that there's been a dynamic in play for a lot of this bull market where you've got this kind of gaming the performance review, and then you've got the sort of aftermath of it. And I think that's been something we've seen here and there, but I think this year it could be particularly interesting, especially if we don't see what you and I have constantly sought out, which is a data-based, quantifiable justification for this rally. Do we see a really dramatic shift in some of the data?
I mean, jobs would probably
jobs helped, right? But ISM certainly didn't.
No, I agree. And
that.
The jobs, I would even argue, would be a one-off considering what we've seen prior in the ADP number and stuff.
It could be, right. And now the ISM services was actually, I think, missed estimates, but it was a reasonably solid number. Global PMIs, copper-gold ratio, positioning, things like that, they've shifted a little bit. Interest rates is another one. Again, long end of the curve, steepener trade. We haven't seen these dynamics start to play out. We've seen the equities market go off on a limb. I think I'll put it that way. We've seen the equities market go off on a limb. And that limb needs to be fattened out by some other asset classes and some core data that justify that move in the equities market that says this is an EPS and PMI reacceleration of the cycle. This is not just people gaming year end. And if we don't see that by, let's say, we get a little bit into January next year, then I would think that, we would have that type of reaction in the market on the other side of it. So it's an interesting thing to pursue.
Yeah, and I mean, all this, of course, coming in front of an election year that could be one of the most divisive in the history of the
building
US.
Uncertainty, right?
Yeah, building that uncertainty. So, all right. Well, Brett, look forward to talking with you tomorrow around this Fed meeting. And, once we've gotten all this data, it's going to be, I think, a fun closing out 2019 sentiment and flow show next Tuesday as well.
Absolutely. It's always fun.
Always fun. It doesn't matter what time of the year, right? So, all right. Well, Brett, we'll keep chatting here and keep you online. But I will talk to you a little bit later then. And again, like I said, we should be back tomorrow ahead of the Fed just to kind of do a last-minute take.
You got it. Sounds good, Gav.
Take care, Brett. Bye-bye.
You too.